So OPEC plus announcing yet another production increase, but it's seen as a modest raise, and not all of this new production may actually end up on the market. So it's a mixed story for oil investors. Let's get more from Daniel Ghali, senior commodity strategist at TD Securities. Daniel, great to see you. Thanks very much. Does that seem like a fair characterization that OPEC plus is being pretty cautious with the increase?
Yeah, well, I think, cautious, I'm reluctant to use the word cautious. And the reason I say that is that this is actually OPEC plus moving beyond the return of the 2.2 million barrels a day of voluntary cuts to the next segment of voluntary cuts immediately, on a back-to-back basis. So I actually think that the signal that OPEC is providing is one where they're not afraid to bring barrels back to the market. They're perhaps emboldened by the fact that oil prices have not fallen significantly since they've resumed bringing barrels back to the market. But this is actually quite a negative signal from an energy market perspective. The silver lining, I think, is that the headline number that they're giving, 137,000 barrels a day, is significantly overstating the amount of barrels that are actually going to hit the market when you take into account the fact that most countries therein have very limited spare capacity. This move effectively only grants Saudi Arabia and the UAE and some marginal barrels thereafter the ability to bring more barrels to the market.
So Daniel, I guess my question is, and for investors, why do you think they want to increase production at this point? Do they believe that there is a shortage? I don't think so. I think, do they want to get market share? Perhaps that is the reason. Why do you think that these extra barrels are coming on, and perhaps even more down the road?
Yeah, the way I see it is that they're providing insurance, and what I really mean by that is really what they're doing is removing paper cuts from the market. Right? There is a massive amount of barrels that are on paper being withheld from supply, but in reality, most countries, again, don't have the ability to bring those barrels back. So what they're doing is removing paper cuts from the market.
Paper cuts, you don't mean sore little injuries from paper, but you mean cuts that were supposed to have taken place, but in some cases didn't.
Right, that's exactly the case. And in fact, raising the capacity or production targets for many of these countries is also going to help the compliance to those cuts, right? Simply by affording them more ability to produce. So really what this is getting the house in order. And I think, as time progresses, the market is going to have to start to consider that the global spare capacity is starting to get stretched. So that theme is going to come back into play, perhaps, in the final months of this year, but certainly over the course of 2026.
Daniel, could we switch gears to gold here? Can you remind us what your call on gold has been? Bullion, as you know, hitting a new record high today.
Yeah, absolutely. We've been very constructive on gold for quite some time. We think that actually this latest rally, which has been exacerbated by the last two non-farm payrolls reports, reflects the fact that macro funds have actually been on the sidelines since the immediate aftermath of Liberation Day. Right, gold has been trading as technically overbought, but underowned for many of the last months since April. And the latest rally reflects an adjustment therein. Macro funds are now starting to add to their gold holdings. And even at this juncture where we think gold prices are trading a little bit rich relative to other traditional indicators, this simply reflects that fact.
Do we know who the main buyers of gold are? I heard the Chinese recently are obviously trying to diversify away from the U.S. dollar. Is it the Chinese that are buying gold? Are they the ones responsible for a lot of this, I guess, spike in price, or maybe not a spike, but increase in price?
Yeah, I mean, certainly over the last several years, less so over the last month or so, right? We've rallied significantly, almost $300 an ounce, with very little evidence of large-scale buying activity originating from Asia. I actually think that this latest rally is originating in the West and is primarily a function of algorithmic trend followers and macro funds that are now finally stepping off the sidelines and starting to buy gold.
Would you see much upside for gold from here, Daniel?
We think gold is actually in for a tactical pause at this moment. And, we remain strategically bullish. That's on the basis of, what we think is the primary mega theme underscoring all global markets today, which is simply that the US dollar is at least partly losing its store of value function. Historical analogies suggest that gold is extraordinarily well placed to benefit from that mega trend. But from a tactical perspective, we've already come a long way. Fund positioning has started to increase. We think a tactical pause at this juncture is more likely than not.
And just remind, what is your view on the US dollar? You do think its status has been eroded as a reserve currency, but I guess these things take years to play out.
Yeah, precisely, right? I think a lot of what's happening in the FX world relates to hedging activity, but we think the US dollar is going to feel more pain throughout the rest of this year and potentially into 2026. But more importantly, right, gold's rally isn't necessarily a function of demand, it's a function of trust. Trust in the US dollar has started to erode, and gold is benefiting from that mega trend.
Daniel, we better jump. Thank you very much indeed for joining us as ever.
Thank you so much.
Daniel Ghali, Senior Commodity Strategist at TD Securities.